Right now, something unusual is happening beneath the surface of the global financial system. Gold is rising. Even when markets appear calm, central banks are buying more than at any time in modern history. Countries are quietly reducing reliance on the US dollar, and geopolitical tensions are reshaping the architecture of global power. Most people think gold rises because of inflation, but history shows something far more important. Gold rises when trust begins to fracture. And today, trust is under pressure everywhere. If you believe gold is just another commodity, you may be missing one of the most important financial shifts of this decade. Because the forces quietly building beneath the global economy right now could shape the flow of wealth for years to come. And by the time these changes become obvious to everyone, the move may already be underway. To understand what may happen next, we need to step back and ask a deeper question. Why does gold surge during certain moments in history and remain silent during others? The answer is not price. The answer is confidence. Gold has always been more than a metal. It is a barometer of trust. When confidence in the system is strong, gold sleeps. When confidence weakens, gold begins to stir. We saw this in the 1970s, when inflation and currency instability sent gold soaring more than 20 times. We saw it again after the 2008 financial crisis, when central banks printed trillions and investors began questioning the stability of the financial system. And today, the early signals of another shift may be emerging. But the forces are not just economic. They are geopolitical, they are structural, and they are global. The first hidden force shaping gold's future is central bank accumulation. For decades, central banks were net sellers of gold. It was viewed as outdated, a relic replaced by modern financial systems. But that trend has reversed dramatically. In recent years, central banks have been purchasing gold at the fastest pace in modern history. China, India, Turkey, Middle Eastern nations, Eastern European countries. The list continues to grow. This is not speculative buying. This is strategic positioning. Why are nations accumulating gold now? Because gold carries no counterparty risk. It cannot be frozen. It cannot be sanctioned. It cannot be printed. In a world where financial sanctions have become geopolitical tools, gold represents monetary sovereignty. This shift accelerated after the freezing of Russia's foreign reserves. That event sent a shockwave through global central banks. It demonstrated that foreign currency reserves held abroad can become inaccessible overnight. Gold, however, remains outside that system. This realization did not produce headlines, but it changed behavior, and central bank demand does not respond to daily price moves. It is long-term, strategic demand that matters, because it permanently alters the global supply-demand balance. But central bank buying is only one piece of the puzzle. Another powerful force is the gradual restructuring of the global monetary order. For decades, the US dollar has dominated international trade and global reserves. This system created liquidity, stability, and efficiency, but it also created dependency. Today, that dependency is slowly evolving. Energy trade in local currencies is increasing. Bilateral trade agreements bypassing the dollar are expanding. New payment systems are emerging outside traditional Western financial networks. This does not mean the dollar disappears. It means the system may become more multipolar. And during periods of monetary transition, gold historically plays a stabilizing role. Gold is politically neutral. It does not belong to any one nation. It becomes a bridge when trust between currencies weakens, but there is another layer to this shift. Global debt levels are at historic highs. Governments carry debt burdens not seen outside wartime. Maintaining long-term monetary stability under such conditions becomes increasingly complex. Historically, high debt environments often lead to currency debasement, financial repression, or prolonged inflationary pressures. Gold historically performs well in environments where currency purchasing power becomes uncertain. And uncertainty not inflation alone, is the key driver. The third force shaping gold's trajectory is persistent inflation risk. Even if inflation declines from recent peaks, the structural drivers remain: aging populations, energy transition costs, supply chain restructuring, geopolitical fragmentation, rising fiscal deficits. These forces increase the probability of long-term inflation volatility. Gold historically performs not simply during inflation, but during uncertainty about inflation. When purchasing power becomes unpredictable, gold becomes attractive as a stabilizing asset. But perhaps the most powerful force influencing gold is geopolitical instability. Gold rises when the world feels uncertain. Trade conflicts, regional wars, sanctions, hegemonies, strategic rivalries all increase demand for safe haven assets. We saw gold surge during Cold War tensions. We saw it rise following major geopolitical shocks. Today, the world is entering a period of renewed great power competition. This does not guarantee conflict, but it increases uncertainty and markets price uncertainty. Another critical factor influencing gold is real interest rates. Gold does not yield income. So when real interest rates are strongly positive, gold may struggle. But when real rates decline or are expected to decline, gold often strengthens. Today, markets are questioning how long high real rates can be sustained in a highly indebted global economy. High rates increase borrowing costs for governments, corporations, and households. Over time, financial pressure builds. If rates ease or inflation outpaces yields, real rates fall. Historically, that environment supports gold. But beyond economics lies psychology. Gold is driven not only by data, but by perception. Markets move on expectations. Gold often rises before crises become visible. In 2008, gold surged before the full financial collapse unfolded. In the 1970s, gold accelerated before inflation peaked. Gold moves when confidence begins to erode, not when collapse is obvious. And confidence today faces pressure from multiple directions simultaneously. But here is something many people misunderstand. Gold is not a replacement for financial systems. It is insurance against uncertainty. It does not produce income. It preserves purchasing power, and that distinction is critical, because gold performs best when systems are stressed, not destroyed. It stabilizes portfolios during uncertainty. It is protection, not speculation. So what happens if these forces continue to build? If central bank buying continues, long-term demand remains strong. If monetary diversification expands, gold's role as a neutral reserve asset grows. If inflation uncertainty persists, gold retains its protective appeal. If geopolitical tensions rise, safe haven demand increases. If real rates decline, financial conditions become more supportive. No single factor guarantees a surge, but together they create structural support. Gold does not move because of headlines. It moves because of systems. And those systems are evolving. This does not mean gold rises in a straight line. Corrections are normal. Volatility is natural. Markets breathe, but structural demand outlasts short-term noise. History teaches that wealth preservation is not about predicting exact prices. It is about recognizing shifts in the environment. Gold has preserved purchasing power across empires, currency collapses, wars, and financial crises. Not because it generates yield, but because it exists outside political systems. And in times of transition, assets outside systems gain importance. The question is not whether gold will fluctuate. It will. The question is whether the forces shaping the global financial landscape are becoming more stable or more uncertain. Because gold responds to uncertainty. And today, uncertainty is no longer temporary. It is structural. Central banks are repositioning. Currencies are diversifying. Debt burdens are expanding. Geopolitical tensions are rising. Confidence is evolving. And gold sits quietly at the intersection of these forces, not dominating headlines, not chasing trends, but absorbing signals. History shows that when multiple structural forces align, the results unfold gradually. And then suddenly, gold does not predict crises. It reflects trust. And trust is the foundation of every financial system. Understanding gold is not about predicting price. It is about understanding confidence. Because when confidence shifts, capital moves. And when capital moves, markets follow. Financial history leaves clues. The question is, are you paying attention?